Hello everyone. Let's start today's new topic, forward rates. It's part of learning module, the term structure of interest rate. Very important from exam point of view. We should be getting one practical numerical question from this topic. But before starting forward rate concept, expected यही रहेगा कि everyone should know what is spot rate and how spot rate is used for valuation of a bond. In case of government bonds, spot rates are the yield on the zero coupon government securities of Z1 represent yield on 1 year zero coupon government security bond, government security. Z2 represent spot rate of 2-year Z bond government security. So spot rates are basically the YTM of zero coupon government bonds. एंड हमने इन स्पॉट रेट्स को यूज किया था नो आर्बिट्राज प्रिंसिपल को यूज करके एक एनुअल और सेमी एनुअल कूपन पेइंग बॉन्ड, जो कूपन पेइंग बॉन्ड है गवर्नमेंट के, गवर्नमेंट सिक्योरिटीज है, उनका वैल्यूएशन कैसे होगा वो हमने देखा लास्ट टॉपिक में. उसके बाद में अगर हमें इन स्पॉट रेट्स को कॉर्पोरेट बॉन्ड के वैल्यूएशन के लिए यूज करना है तो अब कॉर्पोरेट बॉन्ड्स में और गवर्नमेंट बॉन्ड्स में डिफरेंस क्या है. कॉर्पोरेट बॉन्ड और गवर्नमेंट बॉन्ड में मेजर डिफरेंस है क्रेडिट रिस्क का. तो हमने ये कॉन्सेप्ट भी देखा जेड स्प्रेड के फॉर्म में कि आप जीसेक के जो स्पॉट रेट्स हैं उसमें आपको एक जेड स्प्रेड इंक्लूड करना पड़ेगा एंड देन दैट कैन बी यूज फॉर वैल्यूएशन ऑफ ए कॉर्पोरेट बॉन्ड. यहां पे अब हम फॉरवर्ड रेट की जब बात कर रहे हैं तो ये मान के चलेंगे कि स्पॉट रेट्स का कंप्लीट कॉन्सेप्ट आपको आता है, अदरवाइज प्रीवियस वीडियोस आप देखें. नेक्स्ट लेट्स मूव टू दिस टॉपिक फॉरवर्ड रेट. बहुत सारे क्वेश्चंस अलग अलग वैरायटी के बन सकते हैं. सबसे पहले व्हाट इज फॉरवर्ड रेट और इंप्लाइड फॉरवर्ड रेट है क्या, हाउ इट इज प्रोनाउंस्ड, बोला कैसे जाता है, 3y 1y और इंप्लाइड फॉरवर्ड रेट IFR 3,1 का मीनिंग क्या है, नंबर 1. नंबर 2, ये इंप्लाइड फॉरवर्ड रेट कैलकुलेट कैसे होगी और ये है क्या, कॉन्सेप्ट क्या है इसके पीछे, और इस कॉन्सेप्ट को यूज करके क्या इन्वेस्टर को कोई डिसीजन में हमें हेल्प मिल सकती है क्या, कि हमें कहां इन्वेस्ट करना चाहिए, शॉर्ट टर्म बॉन्ड में इन्वेस्ट करना चाहिए या लॉन्ग टर्म बॉन्ड में इन्वेस्ट करना चाहिए, वो एक तरीके का क्वेश्चन बन सकता है. नेक्स्ट, स्पॉट रेट्स के थ्रू अगर स्पॉट रेट्स अवेलेबल है, जो कि अवेलेबल होगी मार्केट में बिकॉज स्पॉट रेट्स आर दी यील्ड ऑन जीरो कूपन गवर्नमेंट बॉन्ड, तो उन बॉन्ड्स के यील्ड जो कि डिमांड सप्लाई ऑफ मनी से फोर्सेस से हमारी ये यील्ड ऑलरेडी कैलकुलेटेड होगी, उनसे कैसे हम इंप्लाइड फॉरवर्ड रेट कैलकुलेट कर सकते हैं. और अदरवाइज अगर इंप्लाइड फॉरवर्ड रेट्स और फॉरवर्ड रेट्स आर अवेलेबल है तो उनसे स्पॉट रेट्स कैसे कैलकुलेट होगी. एंड लास्ट वन, स्पॉट रेट्स, यील्ड और फॉरवर्ड रेट तीनों से बॉन्ड का वैल्यूएशन क्या होगा, क्या ये सेम होगा या अलग होगा. ऑफ कोर्स हम गवर्नमेंट बॉन्ड पे ही करेंगे बात, क्योंकि कॉर्पोरेट बॉन्ड में रिस्क, क्रेडिट रिस्क का इंपैक्ट आएगा. एंड इसके लेटर नेक्स्ट वीडियो में हम बात करेंगे रिलेशनशिप बिटवीन स्पॉट रेट, फॉरवर्ड रेट एंड पार रेट ऑल्सो, उनके कर्व्स के बीच में क्या रिलेशनशिप. तो शुरू करते हैं हमारा फॉरवर्ड रेट. फर्स्ट ऑफ ऑल व्हाट इज इंप्लाइड फॉरवर्ड रेट. तो इंप्लाइड फॉरवर्ड रेट इज ब्रेक इवन री इन्वेस्टमेंट रेट. नाउ अब ये ब्रेक इवन री इन्वेस्टमेंट रेट क्या होता है और इसको प्रोनाउंस कैसे करेंगे. सो जब मैं बात करता हूं फॉरवर्ड रेट्स, वन वाई, of course these rates are annualized rates first of all, यानी नंबर तो पर एनम ही होगा, वो मल्टीपल पीरियड के लिए हमें दे सकते हैं ये, पर रहेगा एनुअलाइज्ड. व्हेन आई से 1 ईयर 1y या फिर हम इसको IFR 1,1 लिखें, इट इज 1 ईयर into the future 1 ईयर फॉरवर्ड रेट. अब इसका क्या मतलब है, इसका मतलब है कि अगर आपका टाइम पीरियड T0 से T1 और T2 है तो हम 1 साल इन द फ्यूचर जाएंगे और उस एक साल के बाद में हमारी क्या रेट एप्लीकेबल है, ये हमारी IFR 1,1 है। एक और एग्जांपल लेते हैं, 3Y 1Y और IFR implied forward rate 3,1. It means 3 year into the future, 1 year फॉरवर्ड रेट। इसका मतलब क्या हुआ, अगर हमारी ये टाइम सीरीज है 4 साल की, अब T3 एंड T4, तो आपको यहां से ये रेट एप्लीकेबल अवेलेबल T0 पे है या कैलकुलेट T0 पे कर रहे हैं, आपको 3 साल आगे जाना है और 3 साल के बाद जो 1 ईयर का एडिशनल इन्वेस्टमेंट होगा उस पे क्या रिटर्न अप्लाई होगा, दैट इज दिस रेट IFR 3,1। एक और बात करते हैं, 2,2Y 3Y या IFR 2,3, इट मींस 2 ईयर इनटू द फ्यूचर, आपके 5 साल का सीरीज है, T0, T2, T3, T4 एंड T5। 2 ईयर इनटू द फ्यूचर जाइए और 2 ईयर इनटू द फ्यूचर के बाद में अगेन ये रहेगा पर एनम, ये 3 साल का कंबाइंड रेट नहीं है। तो अगर आपको 2 साल के बाद में अगले 3 साल के लिए इन्वेस्टमेंट करना है, व्हाट विल बी दी पर एनम रिटर्न अवेलेबल इन दी मार्केट, ये उस रेट को शो करता है। 2 ईयर इनटू द फ्यूचर, 3 ईयर फॉरवर्ड रेट। सो आई होप प्रोनाउंसिएशन समझ में आया। अब नेक्स्ट बात यह आई कि व्हाई इट इज कॉल्ड एज बेंचमार्क री इन्वेस्टमेंट, ब्रेक इवन री इन्वेस्टमेंट रेट। व्हाई इट इज कॉल्ड एज ब्रेक इवन री इन्वेस्टमेंट रेट। तो ब्रेक इवन री इन्वेस्टमेंट रेट का कॉन्सेप्ट क्या है, देखें। ब्रेक इवन री इन्वेस्टमेंट रेट, तो हमने कुछ प्रीवियस वीडियो में स्पॉट रेट्स को यूज किया था, हम उन्हीं स्पॉट रेट्स को यूज कर लेते हैं। पार रेट के लिए भी किया था, हम उन्हीं स्पॉट रेट्स को बॉन्ड वैल्यूएशन के लिए भी यूज किया था, तो हम अब उसी डेटा को वापस यूज कर रहे हैं फॉरवर्ड रेट्स कैलकुलेट करने के लिए। तो अब हम यहां पर क्या कैलकुलेट करने की कोशिश कर रहे हैं, फॉरवर्ड रेट। हमारे पास में ऑलरेडी मार्केट से डेटा अवेलेबल है। किस चीज का डेटा अवेलेबल है, कुछ स्पॉट रेट्स हमारे पास अवेलेबल है। 1 ईयर की स्पॉट रेट कितनी है, 1 ईयर जीरो कूपन बॉन्ड गवर्नमेंट सिक्योरिटी बॉन्ड कितना रिटर्न दे रहा है, 8%। 2 ईयर जीरो कूपन बॉन्ड क्या रिटर्न दे रहा है, 9%। 3 ईयर 10% एंड 4 ईयर इज गिविंग अस 11% पर एनम। ऑफ कोर्स ये भी सारी रेट्स क्या है, पर एनम बेस पे ही कैलकुलेट हुई है। Now we want to calculate, let's say, IFR three comma one implied forward rate for 3 year into the future, 1 year forward rate. What will be the IFR 3,1 3Y 1Y? 3 साल के बाद में अगर मैं 1 साल के लिए इन्वेस्टमेंट करूं तो मुझे कितना रिटर्न मिलना चाहिए, ब्रेक इवन अगर मुझे अचीव करना है। ब्रेक इवन का मतलब क्या हुआ कि आपके पास में 2 ऑप्शन है, आपके पास में 2 जीरो कूपन बॉन्ड का डेटा अवेलेबल है, ऑप्शन 1 एंड ऑप्शन 2। ऑप्शन 1 क्या है, आप 3 ईयर के लिए जीरो कूपन 3 ईयर जेड बॉन्ड में इन्वेस्ट करिए। इन्वेस्टमेंट पहले तो ये होगा प्लस 1 ईयर इन्वेस्टमेंट ऑफ मैच्योरिटी अमाउंट, जो भी आपने जेड बॉन्ड में इन्वेस्टमेंट किया है एक्स अमाउंट, जो आप T0 पे टुडे आप इन्वेस्टमेंट करोगे, 3 साल के बाद अगर जेड बॉन्ड 3 साल के जेड बॉन्ड में इन्वेस्टमेंट किया है तो रिटर्न इंक्लूड करके जो भी रिटर्न मैच्योरिटी आएगी हम उसको वापस से इन्वेस्ट करेंगे फॉर एडिशनल 1 ईयर इन्वेस्टमेंट ऑफ मैच्योरिटी अमाउंट फॉर इन्वेस्टमेंट ऑफ मैच्योरिटी अमाउंट फॉर 1 एडिशनल ईयर। सेकेंड केस ऑप्शन 2, हम स्ट्रेट 4 ईयर जेड बॉन्ड में इन्वेस्टमेंट कर लेते हैं। हम स्ट्रेट 4 ईयर जेड बॉन्ड में इन्वेस्टमेंट कर लेते हैं। इंपैक्ट क्या होगा? तो अब हमारे पास में जो डेट्स हैं, जो रेट्स अवेलेबल हैं, वो है 10% और 11%। आइडियली इन इक्विलिब्रियम सिनेरियो, परफेक्ट मार्केट सिनेरियो विथ इंफॉर्मेशन एफिशिएंसी, अगर आप दोनों ऑप्शन की बात करें तो दोनों में टोटल टेन्योर 4 इयर्स का है। और अगर दोनों में टोटल टेन्योर 4 इयर्स का है और अगर हम इक्वल अमाउंट इन्वेस्ट कर रहे हैं दोनों ऑप्शन में, तो आइडियली हमारे पास में T4 पे इक्वल मैच्योरिटी वैल्यू जनरेट होनी चाहिए दोनों इन्वेस्टमेंट से। इक्विलिब्रियम सिनेरियो में दोनों का मैच्योरिटी अमाउंट एट T4 शुड बी इक्वल। तो आई कैन से, बट मैं एडिशनल किस रेट पे, एट what rate I should be investment of maturity amount for one additional year at the rate X%, or this X% is 3y 1y or IFR 3,1. Implied from these two portfolio, what is the implied return I should be getting for that one additional year? So if I write this, the maturity values of these two portfolios, portfolio 1 will give present value multiplied by 1 plus Z3 power 3, 3 years cube, power cube, 3 year investment at 10% return. 3 year Z bond spot rate is 3 year. Z bond is having a yield of 10%. And this combined maturity, this maturity of this whatever present value we have invested will be invested for one more additional year, IFR 3,1 for 1 year, power 1. And this should be equals to present value of the same amount which you are investing in option 2 at 1 plus Z4 power 4. Both the side we have PV, so we can cancel this PV. Now ultimate equation what we are left with is 1 plus Z3 power 3 multiplied by 1 plus IFR 3,1 power 1 should be equals to 1 plus Z4 power 4. Let's calculate the IFR 3,1 from the data 10% and 11%. 1.10 cube 1 plus IFR 3,1 implied forward rate 3 year into the future 1 year rate power 1 1 year compounding 1.11 power 4. So IFR implied forward rate 3,1 is equals to 1.11 power 4 upon 1.10 power 3 whole power 1 by 1 minus 1 multiplied by 100. So let's find out what is the implied forward rate in this case. Divided by 1.1 square divided by 1.1 minus 1 multiplied by 100. This gives you a rate of 14.055% per annum. And this is your implied forward rate from these two portfolios. Now let's say, as an investor, I expect that the 1 year return after 3 years, 1 year return after 3 years will be more than this 14%, let's say 15%, or otherwise 13% less than this implied forward rate. What should be my decision? Whether I should invest in a short-term bond or a long-term bond. That can be a question in the exam. But now back to this topic. Now this implied forward rate means that if you want to match the maturity values, the market should be giving this return for 1 year after 3 years to break even these two options, to equate the value of these two options. So let's see if it is different. If the expected return for 1 year after 3 years or 3 years into the future is greater than IFR 3,1 let's say it is 15%, case 1, and case 2, if expected return for 1 year, 3 year into the future, or after 3 years is less than implied forward rate 3,1, let's say it is 13%, what will happen to the maturity value of both the portfolios? What will be the impact, compounding impact? Let's say the investment amount is, initial investment amount is 100. So case 1, case 2, or I'll go for 3 cases. This is case 3, and we have one more case, case 2, where expected return for 1 year after 3 years is equals to IFR 3,1. Let's calculate the all 3 cases and case 2. Option 1, maturity value in this case, case 1 will be equals to, how much will be the maturity value? Let's find out. 100 will be invested for, if we invest, option 1 is 3-year Z bond at 10% and then 1 additional year investment at the rate, expected rate. So 100 into 1.10 power cube multiplied by 1.15, which I am expecting that I will be getting 15%. Today I am taking decision at T0. Today T0. I am expecting that after 3 year rate will be 15%. So what will be the maturity value if I invest for 3 year in the Z bond at 10%, and then I will invest the maturity value from that Z bond for additional 1 year at my expected rate, that is 15% for 1 year. Let's see what is the maturity value. The maturity value will be 1.1 yx3 multiplied by 1.15 multiplied by 100. So it will give me a maturity value of 153.07. Second case, equals to the rate what we have already calculated, 1.10 cube multiplied by 1.14055. Let's see what is the maturity value. 100 or 1.1 yx cube multiplied by 1.14055 multiplied by 100. So if the expectation and the IFR what we have calculated is same, I will be getting 151.81 as my maturity value. Third case, what will be the maturity value? 100 into 1.10 cube multiplied by 1.13. It will give us 150.40 as the maturity value. Now option 2, directly investing in a 4-year Z bond. So it will give you into 1.11 power 4, the 4-year spot rate is giving us 1.11 yx is giving you 151.81. 151.81. This will be same because there is no change in the return for 4th year. It's the same 11% per annum which you are going to get as your return for 4th year, 1 to 4th year. So in comparing these, we can conclude that what we can conclude is, in first case, if your expectation that after 3 years the market rate will be higher than the IFR, implied forward rate, you should invest in short-term bond and reinvest maturity amount for additional time of 1 year. Here in this case, we will be indifferent because this is the benchmark reinvestment rate, a break-even reinvestment rate. Break-even, that rate of 14.055, what it is doing, it is creating a indifference point between option 1 and indifference point, option 2. It is equating the maturity values. That is why we are saying it is break-even. At this point, this rate, investor is not going to get additional profit or loss by investing in either of the option 1 or option 2. Next, in this case, you should invest in long-term bonds. So from here, we have concluded decisions that in this case, expectation is higher than IFR, go for short-term bonds and reinvest. This is break-even situation. Break-even situation, so it is indifferent. And in this case, when expectation is lower than your implied forward rate, implied break-even reinvestment rate, you should directly go into your long-term bond so that there is no uncertainty of your returns. So with this, now we understood that this implied forward rate will be very important for decision related to short-term investing or long-term investing. Next, second thing, now can we generalize this formula of implied forward rate? Yes. Using this equation, same equation, we can also generalize the implied forward rate. Let's go for another situation. If I want to calculate implied forward rate for 3 years into the future and for 2 years period, 3y, 2y. So what I am doing is, it's a 5-year series and we have split the series into 2 parts, from T0 to T3 and from T3 to T5. Let's say this is time B, this is time A. B is long tenure, the total tenure, and A is the starting point of forward rate. Ideally 1 plus Z3 power 3 multiplied by 1 plus implied forward rate for 3 years into the future for 2-year period, power square, because now period will be 2 years and this rate is annualized, so we have to compound it for 2 years, should be equals to 1 plus Z5 to the power 5, Z5 to the power 5. So this gives us a generalized equation, 1 plus ZA power A multiplied by 1 plus implied forward rate of A comma B minus A whole power B minus A should be equals to 1 plus Z5 power 5, and this is implied forward rate. This is the break-even reinvestment rate. At this rate, you should be investing after 3 years to match the maturity value of option 1, 3-year plus 2-year investment, and option 2, 5-year investment. So from this, we can generalize implied forward rate of A comma B minus A will be equals to 1 plus, this will be ZB, 1 plus ZB upon 1 power B upon 1 plus ZA power A. Power will go to right hand side as a 1 upon B minus A whole minus 1 multiplied by 100. This is the generalized formula of implied forward rate, which we can use to find out forward rate for any period. So let's go for one more example. Let's change the numbers and calculate the forward rate spot of various period using the spot rate. Let's say the years 1, 2, 3, 4 and 5. The spot rates per annum are 3%, 4%, 5%, 6% and 7%. What will be the forward rate 0, 1, 0y, 1y, or I'll say implied forward rate of 0, 1. It is nothing but else your Z1. Forward rate for 1 year from today, from T0. It's as good as your spot rate of 1 year. From today, you are going to get a return of 3% if you invest for 1 year. Now question is, what will be the rate for return for 1Y, 1Y? It means we are calculating implied return, implied forward rate of 1 year period, 1 year into the future. It will be the 1.04, the long term period, total tenure, power square, 1 plus ZB up power B, 1.03 power 1, whole power 1 by 1 minus 1 multiplied by 100 gives us 5.0097% per annum. So this is a 1 year rate, 1 year into the future. Next, let's calculate 2 year into the future, 1 year rate, 1 year forward rate. IFR 2,1. So now we have 3 years period. So we will use 3 years Z bond rate, power cube upon 1.04 power square whole power 1 upon 1, 3 minus 2 is 1, minus 1 multiplied by 100 gives us 7.0289% per annum. So if I want to break even my two options, short term and long term, the implied forward rate after 2 years for 1 year should be equals to 7.0289. Now if I want to calculate 2 year into the future, 2 years rate, implied forward rate of 2 year into the future for 2 years, it will be 1 plus the 4 year rate 0.6. So 1.06 power 4 upon 2 year rate 1.04 square whole power 1 upon 4 minus 2 is 2 minus 1 multiplied by 100. This is equals to 8.0385, but this is again per annum rate. So now we have done two things. Number one, how to calculate implied forward rate. We have derived this formula. Number two, decision related to investment, whether to invest in short term or long term bond. If the expectation about the future interest rate is greater than forward rate, implied forward rate, or lower than implied forward rate. So दो चीजें कर ली हमने. Now if forward rates are available, can we calculate spot rates? Yes, we can calculate spot rates. And second, can we do the valuation of bond using the, of course we have already done with the spot rate, can we do it with the forward rates also? Of course. How to do this? Let's go for the next part, that is calculation of spot rates if forward rates are available. So now we have 1y, 0y, 1y is equals to 3%. It is as good as your spot rate for 1 year. We have 1y equals to 5.0097%, and we want second 2 year spot rate as question mark. We want we have 2y 1y is equals to 7.0289%, and we want Z3 as question mark. So now how to calculate various spot rates? Implied forward rate. If I invest in 1 year bond, I will get 3%. and then I will invest the maturity amount for additional 1 year at this rate 5.0097. Ideally, it should give the total maturity equals to the maturity if I would have invested in a 2-year Z bond. So 1 plus Z2 power square should be equals to 1 plus Z1 power 1, 1 plus IFR 1 comma 1. So this is equals to 1.03 multiplied by 1.050097. So 1 plus, so Z2 is equals to 1.0816. So Z2 is equals to, we have to shift, Z2 is equals to square root of 1.0816 minus 1 whole multiplied by 100 gives us, of course it should come 4%. From there on, that 4% rate only, we have derived this 5.0097. So if we do the reverse calculation, it should give 4%. Z3 should come how much? 5%, and so on. So from forward rates also we can calculate spot rate. From spot rate we can calculate forward rate, and forward rate is our break-even reinvestment rate. Will be helpful in making decision related to short-term and long-term bonds. Now let's go for the valuation of bonds. Let's go for the valuation of bonds. So now I am going to value a let's take the example of that spot rate and valuation of a bond using spot rates. I think we have done that and we have calculated the let's see, these are the spot rates, and we were valuing a 10% annual coupon paying bond with a face value of 1000, and we were having these spot rate at 8%, 9%, 10% and 11%. And now we want to calculate the, okay, we calculated the forward rates. Yes, 3 year, 4 years, we have 1 year rate. Okay, now we need to calculate various forward rates also. So we have 0y 1y equals to 8%. We have 1y 1y is equals to, it will be equals to, and this we have calculated 3y 1y is equals to 14.055%. Let's see if 2y 1y is equals to, it will be equals to, let's calculate quickly. So 1y 1y will be equals to 1.09 square, the long term period, upon 1.08 power 1 by 1 minus 1 is equals to, let's see how much, 1.09 square divided by 1.08. This is equals to 10.01%. So we have got 10.01%. Next case, 2y 1y will be equals to the 1.10 cube power cube 1.09 square whole power 1 by 1 minus 1. Let's see what is the value. 1.1 yx cube, the 3-year rate, 1 plus zb power b upon 1 plus za power a whole power 1 upon b minus a, that is 3 minus 2, 1 upon 1 minus 1 multiplied by 100. So we have got all the forward rates also. Now can we calculate same value of bond with the help of these forward rate? Yes, we can. So what was the bond we were valuing in case of spot rate? In case of spot rate, we have used a example of 10% annual 4-year coupon paying bond with face value of 1000 each, and now we are valuing this also with the help of forward rates. With the help of forward rates. Valuation of bond. This is the time series 1, 2, 3 and 4. We want to calculate value here. We will receive 100, 100, 100, 100 plus 1000. Using the spot rates, we can value the spot rates will discount cash flows with their respective timing 1 plus Z1. That is, your rate is how much? What is the rate we were using? 8, 9, 10 and 11. 8, 9, 10 and 11. 1.08 power 1. 100 upon 1.08 power square. 100 upon 1.08 power cube. Not 9, 8. It's 100 upon 1.09 power square. 1.10 power 3 and 1100 upon 1.11 power 4. What we have done, we have used the spot rates here. The formula says the value is equals to, it is PMT upon 1 plus Z1 power 1, PMT upon 1 plus Z2 power 2. This is the no arbitrage principle, which we have already done in case when we were discussing spot rates valuation. Spot rate calculation and valuation of bond using spot rates. PMT upon 1 plus Z3 power cube and PMT plus face value upon 1 plus Z4 power 4. Let's see what is the value we have arrived. 1.08 M plus 100 upon 1.09 square equals to M plus, next is 1.10 yx cube reciprocal into 100 1 4 M plus, and last 1100 divided by 1.11 power 4 equals to 1100 divided by 1.11 power 4 equals to 724 plus this value gives us a value of 976.4 or 50. And I think this we have already done in case of spot rate calculation and valuation with spot rate. Now let's see if we can value using the forward rates. Yes, very much. PMT 1 plus Z, 1 plus Z1 can be replaced with 1 plus implied forward rate 0, 1. 1 plus Z2 can be replaced with 1 plus Z1, 1 plus implied forward rate 1, 1. Next, the third PMT will be replaced as 1 plus Z2 square, 1 plus implied forward rate 2, 1. The same break-even reinvestment equation we are using here. And last, PMT plus future value, the fourth year cash flow, 1 plus Z3 power cube, 1 plus implied forward rate 3, 1. We have replaced spot rates factors with the implied forward rate, and now again replacing other factors Z1, Z2, Z3. Now we have PMT upon 1 plus implied forward rate 0, 1. PMT second, the coupon second, 1 plus implied forward rate 0, 1, 1 plus implied forward rate 1, 1. The third coupon will be PMT upon 1 plus implied forward rate 0, 1, 1 plus implied forward rate 1, 1, 1 plus implied forward rate 2, 1. Last, PMT plus FB 1 plus implied forward rate 0, 1 multiplied by 1 plus implied forward rate 1, 1. What we are doing, we are multiplying various 1 year forward rate into the future times. 1 plus implied forward rate 3, 1, and these all numbers we are already having. we have already calculated. So 100 upon the first implied forward rate is same, the Z bond rate. The second rate is 1.08. What was the forward rate? Forward rate I have calculated here, 10.01%. It is multiplied by 1.1001 plus 100 upon 1.08, 1.1001 multiplied by the third year rate is equals to 2 year into the future. 1 year rate is 12.0276. 12.0276. 12.0276 plus 100 plus 1000 divided by 1.08 multiplied by 1.1001 multiplied by 1.120276 multiplied by what was the 1 year forward rate 3 year into the future. We have done this. 1 year forward rate 3 year into the future is 14.055. 14.055. So 1.14055. Let's see if the values are same. First value 100 divided by 1.08, 92.59. Next 100 divided by 1.08 or 1. Next 100 divided by 1.08 divided by 1.1001. 84.16 or 17. 4 plus 1. The third cash flow is again same, but one more division divided by 1.120276 plus 75.13. 4 plus 1. Now we have to change the values. 1100 divided by 1.08 divided by 1.1001 divided by 1.120276 divided by 1.14055. This is 724.60 plus this values is again giving you 976.49 or 50, and the same value we have got from the spot rates. So using this forward rate and spot rate, we can value our bonds. So ultimately we got our equations as PV equals to PMT if the desired yield is available, 1 plus R to the power 1, PMT upon 1 plus R to the power 2, and so on. Last, PMT plus future value 1 plus R to the power nth. If spot rates are available, of course, whatever we have done on the government securities bond, because if it is a corporate bond, there will be additional spread required for the credit risk. PMT upon 1 plus Z1 power 1, PMT upon 1 plus Z2 power square, and so on. PMT plus FV upon 1 plus Znth power nth. In case you are using forward rates, PMT upon 1 plus implied forward rate, which is for this period, for first year, it is always equals to 0 coupon, 1 year 0 coupon bond yield. From second onwards, it will be 1 plus implied forward rate 0, 1 multiplied by 1 plus implied forward rate 1, 1, and so on. And at the last, PMT plus FV will be equals to 1 plus implied forward rate 0, 1, 1 plus implied forward rate 1, 1 whole multiplied by 1 plus implied forward rate n minus 1, 1. So ultimately we have done the valuation using yields, desired yield, spot rate and forward rate, and we have also done the concept of par rate, the yield where your bond will trade at par value. So let's see what we have written in the text part. Forward rate from spot rate. Implied forward rate are break even in reinvestment rate and this will help you to judge whether to invest in a short term or a long term bond. 3y1y is the, or IFR 3,1 is 1 year forward rate, 3 year into the future. Equation we have already done, and we have used this equation to calculate the IFR, and I think yes, this is the equation. IFR is equals to 1 plus ZB power B upon 1 plus ZA power A whole power 1 upon B minus A minus 1 multiplied by 100. What it says, if the 1 year yield in 3 year time is likely to be lower than IFR, then we should invest in the long term bond. We should invest in the long term bond, 4 year bond. And if 1 year yield is likely to be more than the IFR, it's better to invest in a short term bond and then reinvest that maturity at the higher rate. Reinvest at the higher rate for additional 1 year, and this will create the break even, no profit, no loss in both the option. Valuation part we have done, calculation of forward rate from spot rate and spot rate from forward rate we have done. So with this topic is over, and now we are left with only one topic in this learning module, that is relationship between spot rate, forward rate and par rate. We will cover that in next part. Thank you so much.